I think we have all seen our fair share of market volatility as of late. The February-March of 2020 timeframe was one of the most volatile in recent history, and it was not uncommon to see the Dow Jones up or down over 500 points in a given trading day. So what can the long-term investor do to ignore these short-term fear-mongering and media noise? Two words: SWAN stocks. Hey guys, this is Nick with DOW and welcome back to my channel. In today's video, I want to go over two SWAN stocks to consider buying in 2021 and beyond. I hope this video brings a lot of value to your financial journey. Don't forget to hit the like button and thank you for your support. Let's get into it. What exactly is a SWAN? No, we're not talking about these swans, nor are we talking about a black swan event, an unpredictable market event beyond exceptions with potentially severe consequences. Quite the contrary, SWAN stands for an acronym for Sleep Well at Night SOP. There is no set definition for what SWAN actually means, but it is generally defined as a high-quality investment meant to endure the test of time. If you could choose a stock and not look at your account for an entire decade, would you, the investor, be satisfied with the overall returns or objective of the initial investment, whether it be dividends accumulated or capital appreciation or a combination of both? As the name implies, can you sleep well at night knowing that you hold high-quality stocks in your portfolio during periods of market volatility? I also want to point out that there's no specific financial metrics as to which stocks qualify as a SWAN stock, but to me, SWAN stocks are indicative of a proven business model with a large economic moat and competitive advantage that allows the business to continue to thrive no matter what the future throws at the company. And we have already seen certain companies continue to grow despite a once-in-a-year, 100-year pandemic, AI robotics, and green alternative energy, to name a few. And this is where I think the term SWAN stocks go hand in hand with the legendary Warren Buffett. Buffett first popularized the term circle of competence in his 1996 Berkshire Hathaway shareholder letter, where he writes, "You don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence." He further writes in his 1997 shareholder letter using a Ted Williams baseball analogy. In his book, The Science of Hitting, Ted explains that he carved the strike zone into 77 cells, each the size of a baseball. Swinging only at bats at his best cell, he knew would allow him to bat .400, reaching for the balls in his worst spot, the low outside corner of the strike zone, would reduce him to .23. In other words, waiting for the fat pitch would mean a trip to the Hall of Fame. Swinging indiscriminately would mean a ticket to the minors. What Buffett is basically getting at is that if you are building your own portfolio, you don't need to swing or invest in every company out there, but only a select few based on your circle of competence. The SWAN stocks you do decide to invest in will hopefully hit home runs that far exceeds the S&P 500's performance. As Buffett said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Therefore, I'm going to go over two stocks I consider to be SWAN stocks that I personally invest in. I'm confident in these businesses' capabilities to thrive in the future. As always, this stock video should not be construed as financial advice, but mere educational ideas to consider and further conduct your own due diligence. The first SWAN stock I hold in my portfolio is ticker symbol O, Realty Income, the monthly dividend company in REIT. I recently made an individual video about this stock, so don't forget to check that out next to learn more about what makes this REIT so compelling. Realty Income purchases commercial real estate and leases properties to long-term 10 to 20-year net lease agreements. With over 6,500 properties across 49 states, Puerto Rico, and the United Kingdom, some of its largest tenants include Walgreens, 7-Eleven, Dollar General, FedEx, and Dollar Tree. And here's why I absolutely love Realty Income. Coming from a commercial real estate background, I like to track portfolio occupancy and rent collection rates throughout the good and bad years to ensure that a company is capable of securing long-term net leases, renewing existing leases, and collecting the contractual base rent. And Realty Income's portfolio occupancy rate has never dipped below 96% during the Great Financial Recession and even during the 2020 pandemic. and taking a deeper dive into the rent collection rates, which I consider to be the true metric in determining the health of your tenant portfolio and what percentage are actually paying that contracted rent, you can see that this figure averaged 93.6% during the last quarter of 2020. And for this fourth quarter, you can also see that aside from the health and fitness and theater tenants, the other tenants in the remaining industries largely paid rent. So despite the real estate doom and gloom in the media, don't count out some REITs just yet. There are good REITs and there are of course bad REITs. So the challenge is finding those with top-notch quality properties and recession-proof tenants. I always like to see my SWAN stocks outperform the S&P 500 over the long term, and Realty Income is no exception. Since being publicly listed in 1994, Realty Income has outperformed the S&P 500 with a compounded annual rate of return of 15.3% versus the S&P 500's 10.4%. Critics will say that Realty Income has underperformed the market the past couple of years, but I'll say that the market is cyclical and certain sectors will be in and out of favor like all market cycles. Lo and behold, this illustration represents different asset class returns since 2006. You can see in red the general REIT index and how it underperformed in 2020 for very obvious reasons, but outperformed between 2010 and 2015. Therefore, if you are a long-term investor and continue to accumulate your shares during periods of market underperformance, compound interest along with dividend reinvestment will make you come out on top in the long run. The second SWAN stock I hold in my portfolio is ticker symbol LOW or Lowe's. Lowe's is one of the largest improvement retailers in the world with over 2,200 locations serving 20 million customers a week in the United States and Canada. This company needs no introduction. If you have ever needed materials for a home DIY project or repair, you likely have visited a Lowe's at some point in your life. This is a recession and internet-proof business that has allowed a company like Lowe's to thrive no matter what the decade it is. I love this company because of how well it performed during a time when many companies were uncertain as to how its earnings would be impacted by the pandemic, but Lowe's managed to increase revenues by over 25% from $72.15 billion in 2019 to $89.6 billion in 2020 and increased its annual dividend another 9% in August of 2020. Lowe's is also a highly regarded dividend king, having raised its annual dividend for 58 consecutive years with plenty of room for future increases. For dividend growth companies, you want to be mindful of dividend payout ratios or the ratio that the company pays out in dividend relative to earnings to make sure that earnings are growing fast enough to pay for the increasing dividends. As for Lowe's, the expected adjusted earnings per share dividend payout ratio is around 26% for 2021, despite recent double-digit dividend increases. Going back the past 10 years, thanks to consistent revenues per share and earnings per share growth, as shown on the left, the payout ratio has consistently remained in this range. This means that the company is able to grow its business despite adapting to new industrial and societal changes. Lowe's is also a great example of a low dividend yield company where if you buy and hold for the long term, your yield on costs will be worthwhile. With a current dividend yield of only 1.25% as of this time of recording, that is nothing to write home about, but you'll be hard pressed to find a quality blue chip company with a proven track record of double-digit dividend growth. Lowe's has increased its annual dividends by over 15% in 8 of the last 11 years since 2010. And with these consistent dividend increases factored in, your initial yield on cost, had you held for the past 10 years, would be a whopping 8.83%. And of course, the total return for the company has its shareholders feeling like they won the lotto. From March of 1980 to March of 2021, the total return of share price appreciation and dividend reinvestment was an incredible 145,967.7%, or an annualized rate of return of 19.42%, nearly double the annualized performance of the S&P 500. Dividends played about a 40% role of the total returns, which is a testament to the power of compound interest and dividends and what it can do for your portfolio. I hope my coverage on these two SWAN stocks has given you a better understanding of this acronym of sleeping well at night. I hold Realty Income and Lowe's in addition to other blue chip companies in my M1 Finance account because I can sleep well at night. I no longer have to worry about the short-term day-to-day market volatility. Like Buffett has said, I can rest assured and not look at my investments for 10 plus years because I know that my portfolio will have outperformed the market by the end. As a long-term dividend growth investor, patience is a virtue and is a viable pathway to financial independence. Please note that this video is not intended as financial advice, nor am I a financial advisor. Past performance is no guarantee of future results, and please take the information with a grain of salt. Please do your own due diligence and research when deciding to invest in investable securities. I am just an ordinary guy posting his opinions onto YouTube because I love stocks, dividends, and personal finance. If you found this video helpful, please consider clicking the like button and subscribing to my channel. This helps with the YouTube algorithm and gets my channel noticed. Hit the bell notification to receive the latest alerts, and all engagement is much appreciated. Until next time, take care.